As a real estate agent, I understand the importance of knowing the key factors that affect your ability to qualify for a home loan. So, whether you're a first time home buyer or you're looking to sell your long time home and purchase a new one. So, let's dive into the three crucial aspects of qualifying for a mortgage and discuss how they can impact your home buying journey. Number one, credit score and history. So, your credit score is like a financial report card that lenders use to basically gauge your reliability as a borrower. So, think of it as a snapshot of your physical responsibility, right? Your financial responsibility. So, for instance, a score of 700 or above is often considered good and actually may open the door to lower interest rates and a wider array of loan options. But let's say your score is around 650, certain programs like FHA loans might still be within reach. So they're designed to help those with less than stellar credit or less than perfect credit. So it's also vital to address any discrepancies on your credit report. So maybe you've paid off a debt that's still listed. Rectifying this can improve your credit score, right? They want to wipe it clean, get it out of there. So consider a buyer who had a late credit card payment due to an oversight. Oops, missed a payment. So this might not be a deal breaker if the rest of their credit history is basically strong. But it does underscore the importance of consistency in financial habits, right? I just want to interject, if you are enjoying this information and you find it valuable to get some more information on how not to, mess up credit worthiness during the loan process, I actually wrote a book, 10 Ways Not to Screw Up Your Home Purchase and Make It Successfully to the Closing Table. And I am going to link the ebook for free below in the pinned comment. So there it is if you want it. While a good credit score is crucial, the way you manage your credit is equally as important. So having multiple open credit cards can be a double-edged sword. So on one hand, if managed well, they can improve your credit history by showing that you can handle credit responsibly. However, carrying high balances or maxing out those cards can significantly hurt your credit score. So this is due to the something called the credit utilization ratio. So that is the amount of credit you're using compared to the amount you actually have available on that card. So it is recommended to keep this ratio below 30%. So for example, if you have a credit card with a $10,000 limit, you should try not to carry a balance of more than $3,000 on that card. So use that as a guide. Applying for a lot of credit over a short time can also be detrimental. So each application can result in a hard inquiry on your credit report, which can lower your score. So if lenders see several inquiries in a short period, it can indicate that you are in financial distress or are taking on more debt than you can handle. So for instance, if you apply for 3 credit cards and a car loan all within a few months, this might raise red flags for a mortgage lender. So after a significant financial setback like a bankruptcy or a foreclosure, there is a mandatory waiting period before you can qualify for most home loans. So the length of this waiting period, it can vary depending on the loan type and the circumstances of the bankruptcy or foreclosure. So let's give an example. Conventional loans. After a Chapter 7 bankruptcy, you'll typically need to wait 4 years from the discharge or dismissal date before applying for a conventional loan. So if you've gone through a foreclosure, the waiting period is usually 7 years. So FHA loans, the waiting period after a Chapter 7 bankruptcy is generally 2 years. And after a foreclosure, it's 3 years. However, if the foreclosure was on an FHA loan, the waiting period could be a bit longer. Let's talk about VA loans. So the veteran loans. Veterans may be able to qualify for a VA loan just 2 years after a Chapter 7 bankruptcy or a foreclosure. So let's take the case of, say, John and Sally Doe, right? They filed for Chapter 7 bankruptcy and had it discharged in January of 21. So if they're looking to secure a conventional loan, they will need to wait until January of 2025, which is the 4 years, before they can be considered. However, if they are eligible for an FHA loan, they might be able to apply as early as January 2023. So in each of these scenarios, rebuilding credit is crucial, right? So this can involve getting a secured credit card, becoming an authorized user on a family member's account, or taking out a credit builder loan, which they have out there. So the goal is to establish a new track record of on-time payments and responsible credit use. So understanding these details of credit management and overcoming past financial difficulties is essential for anyone looking to secure a mortgage. So it is not only about meeting the minimum credit score requirements, right, but also demonstrating that you can handle and manage your debt effectively, right? Key factor would be income stability and verification. So lenders don't just look at how much you earn, but how you earn it, right? So salary income is usually the most stable and predictable, which lenders love. So if you're on a salary of just say $50,000 per year, it's basically straightforward. But say you're a freelance graphic designer, your income may fluctuate month to month, or say a real estate agent. Lenders will average the income over the past 2 years. So it is critical to maintain thorough records and tax returns, right? Because they're going to want to see those. Or perhaps you've been a salaried employee and just moved to a commission-based role within the same company. So although your total earnings have increased without the 2 years in this new role, some lenders might not consider this income yet, right? Because they have the 2-year rule. So a lender will look for a 2-year history of consistent or increasing income to ensure reliability. So a key component of your financial health from a lender's perspective is your employment stability, right? So consistent employment within the same industry or role shows the lender that you're a reliable pattern of income, right? Responsible, reliable, however you want to say it, which is basically a strong indicator that you'll be able to meet your mortgage obligations, right? So if you frequently change your jobs, especially to a completely different industry or a different pay structure, well, that can be viewed as a red flag, right? So it may suggest to the lender that your income isn't stable and you could change or cease your employment unexpectedly, right? Increasing the perceived risk of the lender lending money to you. You're a bigger risk. So, for example, a borrower, say, just moved 3 jobs. He moved 3 jobs 3 times, let's say, in the past year, each time to a higher salary, but in different industries. So while their income could be higher and is higher, the lack of continuity can cause concern for the lender. It's like it raises a red flag. Questions about, well, why didn't you finish what you were doing? And now you're going to this career path, and whether your income can be dependent upon really in the long term. So it is especially critical not to change jobs in the middle of the mortgage process. Consider a scenario where the buyer's in the final stages of loan approval, right? And decides, I'm going to take a new job in a different field. I got this offer. I'm going to do it. It's going to be great. I'm going to make more money. But the sudden change could halt the entire lending process because the lender has to reevaluate the borrower's financial situation, including the stability of their new position, right? So even if the new job pays more, the lender has no historical data or to predict whether the borrower's new income will be consistent. So if a job change is absolutely necessary, it should be in the same field where you have established a history, ideally for equal or greater pay and on a similar pay structure, salary to salary. So the best course of action is obviously to inform your lender of immediately of any potential or actual job change, or just don't change the job until you move. So communication is key, as the lender may need to perform additional verification or adjust the loan application based on your new employment situation. So, and this happens, right? So every part of your financial profile, including your job history, it paints a picture for the lender. It's like a paper look at your life. So the goal is to present the most stable and reliable images possible, right? So if you're considering a job change, you got to weigh the potential benefits against the impact that it could have on your loan approval process, all right? So as I mentioned, if you find yourself in a situation where the job change is unavoidable, work closely with your lender to navigate the implications. Okay, the third key is the assets and reserves. So assets, it just goes beyond your savings account. It's just not just the money in your bank account. This is a cushion for the lender, showing that you can handle your mortgage even if you're hit with a rough patch financially, say a global pandemic. So for example, consider a borrower who is aiming for a conventional loan they may need to have enough in the bank to cover a few months worth of mortgage payments post-closing, known as their reserves, right? For an investment property, more likely you're going to need 6 months worth of reserves, because it's an investment property. They know that you have other things that have to get paid for also. So these reserves can be in the form of savings, retirement accounts like IRA or SEP, or even, stocks and bonds. So let's imagine a couple is applying for a mortgage on a second home, right? So they have $30,000 in saving, which covers a down payment and their closing costs. However, if their lender also requires $15,000 in post-closing liquidity, right? Like it's like having in the bank. Fortunately, they have an additional $20,000 in a mix of stocks and a retirement fund, which basically satisfies the requirement and strengthens their loan application. So if your savings don't meet the typical reserve requirements, don't worry, you have options. So many loan programs offer down payment assistance, especially first-time home buyers. And these programs are often tailored to them and for those that have the lower incomes, and that can provide, it provides the necessary funds to cover down payments or even some closing costs. So let's say there's a buyer, he or she qualifies for a down payment assistance program, which grants them $10,000 toward their purchase. So this reduces the amount they need to have saved, and it would potentially cover the entire down payment for an FHA loan. So, which actually requires as little as 3.5% down on an FHA loan. So additionally, gift funds from family members can often be used to cover down payments or reserves. So there are specific guidelines to how these gifts can be used, and they must be properly documented to ensure they are indeed gifts and not loans. So, for example, if a buyer's parents give them $15,000, right? It requires a letter from the parents stating that the money is a gift and not expected to be repaid. So these alternative sources can be extremely beneficial. They not only help in meeting the initial purchase requirements, but they also show that the lender shows to the lender that you have support and means to secure the purchase without the traditional amount of reserves. So it's important to work with a lender who understands how to incorporate these aids into your loan application and can guide you through the process of basically qualifying and using down payment assistance or gift funds, correct? Effectively, right? We want to do it correct, effectively. So as a real estate agent, I focus on guiding my clients, my prospective clients, my future clients, through my past clients, through these aspects, ensuring that they understand how each factor can impact their home purchasing process. So whether you're a first-time buyer overwhelmed by the complexities of a mortgage, or say a seasoned homeowner looking for your next property, right? Understanding these keys to qualifying for a home loan, it is crucial in making informed decisions. So before I sign off, I want to remind you that if you find this information useful, please consider giving this video a like. Your likes significantly help in reaching more people who could benefit from this content. So also, if you are interested in staying updated with more insightful real estate tips and guides, remember to subscribe to my channel. So your subscription not only supports my work, but also ensures that you get all the valuable information you need to make, say, your home buying or selling journey smoother and more successful, right? So remember, if you have any questions or need any assistance in navigating your home buying journey, feel free to reach out for expert guidance. I've been here a long time. I know what I'm doing. I'm here to make your real estate dreams a reality. And thank you so much. I am so grateful that you continue to watch my YouTube videos, and we will see you in the next video.